Thank you for choosing us. You are joining thousands of people who have enjoyed learning with AOG Ingenzi since 2011. Our work has been recognized by His Excellency President Paul Kagame.
Tell me, what do you want from me?
We would want to see you contribute to the rent.
I will do that.
Thank you so much.
That is... I've been paying rent in many places. I won't fail to pay rent in that one. We'll take care of what we can.
By Her Majesty Queen Elizabeth II through the Queen's Young Leaders Award 2015.
So that's splendid, isn't it? To have made such a difference to people. And that picture of you and me when was that taken?
Back in 2015.
Thank you for telling us all about it.
Thank you very much, Your Majesty.
And by Her Excellency First Lady Janet Kagame through the Celebrating Young Rwandan Achievers Award 2021.
Hello, I am Alphonse, facilitator at AOG Ingenzi.
Welcome to the Financial Management on Income Statement course. This course is very interesting. Only two things that have to be considered before we start. Financial is something which is easy, only not two. One, record is necessary on a daily basis. Second, you have to make sure that you separate your recordings. I mean, the business data, separate them with your own data, personal ones. At the end of this video, you will have been able to cover some financial statement key definitions and understand well general income statement. Of course, we'll also use a worked example, a practical one, to generate an income statement using our own data, which will form we'll create some example using our own data to create an income statement, which will help you also to generate yours based on your data in your business. In this part of the financial statement, we'll learn how to arrange business data and make a general income statement. Income statement is also called profit and loss account. In this financial statement, we may start by knowing a bit on some key definitions, mainly financial statement, what is it, income statement, and depreciation. The financial statements are formal records of the financial activities. When we say financial activities, those are expenses or revenues and the position of a business or person or other entity. Relevant financial information is presented in a structured manner and in a form which is easy to understand. We call it structured manner because we have a format that is designed using the standard of accounting. Those formats mainly help us listen the information given by any business or company. So financial statements are comprised with mainly three parts. One, income statement, balance sheet, and cash flow. Income statement is one of the financial statements that shows a company's revenues, expenses, yes, of course, and net income or profit, what you call profitability, over a given period. It is also sometimes called a profit and loss, as I said above. It shows your revenue from selling products or service. Mainly the revenues are coming from selling or products or services, because you're in the business. It shows also expenses used to generate those revenues, and also the operating expenses, the expenses used to manage your businesses. Then the net income, which will come from revenue minus expenses, where we'll see if we realized a profit or a loss. Mainly it's a simple formula, which is taking revenues minus expenses, then see if you have a profit or loss. That's what we call an income statement in simple words. A balance sheet is a statement of financial position of a business that lists the assets, liabilities, and owner's equity at a particular point in time. All those materials, all those formats are in a given period of time to measure the details. So when we say in balance sheet that we have assets are those materials or cash we have in our business on our own, while liabilities are some obligations or debt we have for others. Owner's equity may be defined as capital or money invested in a business. Cash flow statement is defined as the total amount of money being transferred into and out of a business, especially as affecting liquidity. For the cash flow, we only check liquidity. By liquidity here, we mean cash, the real cash you can touch, not saying that we have a brand which has this value. No, in cash flow, we look only anything that touches cash. You may realize cash income from revenue as sales of product or services. You may also have some cash as donations, grant, or whatever. Whatever is expressed as liquidity or cash is recorded into cash flow. Depreciation is a reduction in the value of an asset over a time. We may know it, I don't know if we all know it, but all materials has an expiry date. The depreciation is those expenses that are recorded based on a reduction of that value of that material within over a given period of time. Some material that depreciate are, for instance, vehicles, machine equipment, and others. The following law states where the official obligation to file annual financial statements. The below law details where the rate of different depreciation per item category. This law is published on 16th April 2018. It's official Gazette number 16, which shows in details what is how some companies, not some, many companies and all, I mean, are obliged to file annual financial statements to some government institution like Rwanda Revenue Authority for the case of Rwanda and RDB. And also this law details where also some different items, their rates of depreciation, saying that maybe this item has a duration of 4 years or 2 years. Then this law states where the details of years that any item should last and the rate of its depreciation. Why is it important to make a financial statement? A financial statement helps to provide vital information about the business financial health. The financial statements are also useful for making decisions regarding expansion and financing, because you may have a business. It's better you know your situation, what you have, and where to focus for your business growth. They also figure into marketing decision, providing data indicating which aspect of company operations provide the best return on investment. For instance, you may have different product in your institution that you sell. Those products may have different return on investment. Some may be earning more than others. So by knowing those figures in your financial statement, you may decide where to put other strength during your marketing decisions, or where you have to focus to realize a big portion of profit. They also serve for audit purposes. Of course, the audit, when it comes to audit, they look at those financial statements, or for government institutions, transparency where necessary, because you may be requested to file taxes. They'll be checking those financial statements. So for knowing better about income statement, let's look into practical exercise on income statement within an Excel template. Yes, this is an income statement format that we are going to use to know how easy it is. Only the data you have it. Every company, every business has its own data. Only what you are requested is to put those data into in a structured format, which will help us to communicate our financials. The income statement, as it is seen here in this table of Excel, it is made of a few parts which are necessary, but the main ones is knowing that you will be recording your revenues, your expenses, then by taking your revenues minus expenses, check what you have, if you have realized a profit or loss. That's what we call statements of income. It's an income statement or profit and loss account. You should start by naming your company. It's necessary who report this one. Let's use an example of XYZ Limited. By using your own data, you will use your own name of the company. Yes, the template is income statement or profit and loss, and here you have to put the period. For the period you are reporting, month and year. You precise depending on which month you are in. You may even want to generate or record some data on a daily basis. Then here you will put date, or here put your date in which you are recording your data. The importance is knowing that it's a company name, it's an income statement, it's the period you are reporting, which must be filled before you start putting your data. When starting, you start by filling the revenues. Of course, revenues are coming from product or service you are selling. In income statement, we don't record grants or donation. Only we record what is based on what a company has made or produced or sold. Can be a product or service. So we maybe take a kind of an example so that you can produce some data to put into this income statement. So here it is a part of revenue where we'll have a total revenue. We'll also learn about the cost of goods sold. Those are costs related to production of an item sold. I mean, you may have sold some items, but there is a cost that used to produce those items. Those are cost of good you sold. That's a kind of an expense which should be recorded separately with other operating expenses, even though all of them are expenses. Then here for the operating expenses, these are the the other running expenses on a daily basis, or the general expenses we may call the running expenses or operating expenses, like staff salaries, electricity, stationaries, and whatever that may be considered as general. So let's take an example of someone who sells juices, and it's maybe a boutique or a canteen. They may also sell like some cakes or bread, whatever. They may also have maybe different products. You have to list all of them here, all the products or services that you sell that generate revenues. So here you will put some amount of revenues realized from the sold item like juices or cakes. Let's take some examples of selling liquids. Let's say for instance, you may sell on a monthly basis some quantity of juices. Let's say for instance a 1,000 bottle of juices. This is quantity, and the unit price may be at let's say 800 per bottle of juice. Then on a total we'll be having this time will be having an amount of 800,000 per month. We are using this example, but you will use your own. So we have also some cakes. Let's say also maybe we are selling 2,000 cakes per month. Maybe a cake is costs 100, let's say, for instance. So on a monthly basis, you have 200,000 revenue from the sold cakes. Here we put some total. So these are revenues for this period. So you see, income statement is easy because it's only recording whatever you have in your books or whatever you have recorded in cash from sales. So by looking at these examples, we have 800,000 realized from the juices sold for a given period of a month. And from cakes, we have also 200,000. You see that here we have 1 million. Let me remove those zero after comma. So here you see that we have 1 million as a total revenue from our product selling. So that's the first part of income statement. So for the cost of goods sold, why we call it a cost of goods sold and separate this cost with other running expenses, it's because by producing those juices, by producing those cakes, you may have used some kind of raw materials. We call them also the direct costs. So for these juices, let me put the same figures here. Maybe forgot this pricing. So here we're going to calculate the cost of goods sold. So we will be asking ourselves, the juice we sell, we sold 1,000 juice, yes, but one juice we sold it at 800. How did it cost us for producing this juice or bringing it to the market? Maybe it's 500 per juice as a cost to realize a kind of profit, of course. For the cake, we sold 2,000 cakes, but we may have produced those cakes or purchased, of course, may have a business that purchase and sell at 50. This will be having cost us 100,000. So this total of 600 is called the cost of goods sold. We make this for us to know how we did made pricing, because if we had made an error here to sell this dress at 500, you see that the business can't be viable. You might have checked very well if you realize the big profit at this stage, because you will still have other expenses after deducting this cost of goods sold or what you call raw materials. Then what you have here, it's called gross profit. It's called gross profit because you have other running expenses you have to deduct from it to realize a net profit. Those running expenses are salaries, internet, electricity, telephone, and whatever you have as running costs. So here you will only record what you have. You may have maybe paying some stuff at, let's say, 100,000 for stuff. These are examples, not real figures, but you will put your own real ones so that you realize the best figures of your own you may consider. Electricity you may have used in the past month, maybe 20,000. Those are Rwandan francs. I forgot to mention it. Those are Rwandan francs, or it may depend on the currency you want to use. For the rent, you may have rent a house of 100. It's a house or an office or a plant. It may depend. Those are expenses that are running, that are looking for the general office or general plant. You have to record all those expenses. Telephone may cost you 20k. Internet may cost you 10k. You will have to record all your figures. Website may cost you let's say 10k, 10,000. Bank charges, it may be 3,000. Those are examples. So by putting the direct expense, cost of goods sold, by inserting also the running expenses, it's easy now to know that you have realized a profit or not, because it's only taking the revenues minus expenses. So what I have to mention here is only what considering when we want to consider the depreciation. By depreciation we mean all materials that have duration of more than 1 year. Those materials are furnitures, computers, buildings, lands. Those materials are depreciated over a given period of time. When we are making an income statement, it's a note that those materials that has duration of more than 1 year, their cost doesn't have to be written as it is here in income statement. For instance, for the furniture, you may have purchased furniture for around, let's say, 400,000. Those are tables or chairs. You may also have purchased computer of, let's say, 200. A building here we haven't a building because we are renting. We may also have record some other assets. If we have a land, if you have any other thing, those materials, those assets that has a duration of more than 1 year has to be recorded separately, not as we record other materials. This means that by purchasing furnitures of 400 doesn't mean that we record 400,000 here. No. The official gazette number 16 of 16th April 2018 from Rwandan government states the different rate that affecting those materials. So for the furnitures, it is stated that it has a duration of 4 years. So those are years, while computer is for 2 years. Those are by law. They state that for interest of recording, and the benefit of it, it's knowing where we'll be looking for other materials to replace the old ones. So by saying that furniture has a duration of 4 years, it means the rate of those materials is 25%. 4 years, 100% divided by 4. For the computer, of course, it's 50%. Those are the rate of depreciation each year. So when we say that each year, it means that every year this cost of 400 has to deduct every year the 25% of its original cost. That means that every year the quota, this amount minus 4, it has deducted the value of 100,000 has been deducted to the value of these assets, which means that after 1 year your furniture you have in your office will not have a value of 400, it will have 300. This minus the depreciation, the depreciated amount. So by this exercise, yes, of course, for the computer as well, it's 200 divided by 2 because it has the duration of 2 years. Those are values that are being deducted every year. The remaining after a year as I mentioned earlier, it's the difference. You take the original cost or value minus the depreciated amount. This is the remaining value after 1 year per this law. When you check this law, you may find more. So we are now making an income statement of a month, which means that the expenses of a month will be for furniture. If the expense of a year is 100, it means that the expense of 1 month is 8,300. You take this original amount, you divide by the number of years of its duration, you get the real figure, which is considered as expense of a given year. You divide by 12 months because we are making an income statement of 1 year. So now you get the figure that is considered as expenses for that given items. For the furniture now, we have a figure of 8,333 as expenses for this month we are reporting. It's the same for the computer. It has also deducted its value of about 8,000 for each month. so that maybe after 2 years we'll be having a net zero or residual value of zero, which will show us that you have to buy another new computer, or make sure that we no longer have the computer used to have at its status. Why do we do this? First, it's considering that the materials we have are being depreciated. It will get old either in 2 or 4 years. Second, it's considering that these figures, this amount that are being depreciated within a period should be saved elsewhere, should be saved in a given account, may be called depreciation account, which will help us buy a new machine or a new materials after that asset or machine has been depreciated or damaged. So when you don't do this depreciation, you may have a big machine which costs a huge amount. At the end of 2 or 4 years, the machine is no longer working, and you find yourself without having any amount to buy another new one. But if you do depreciation, you will have saved some given amount slowly when you are making an income statement. That's the interest of using depreciation when recording those kind of assets within an income statement. So this is our income statement. You may also record the taxes. Normally taxes are 30% of net income, but here you record whatever you make as an expenses. If you paid some taxes, you record them here. Transport expenses, normally the business has its own transport for maybe for courier, for materials, for maybe for staff, for joining some workshops, some trainings. Those are expenses that have to be also recorded here. We may have an example of 50k. So these are total expenses. By taking that total revenue minus cost of goods sold, you got a gross profit. Then you minus the running or operating expenses, you got the total running expenses. By deducting all of them, you realize a net profit or a net income. Then this is your income statement. Well done. Not that it is easy, only put your figures. Consider also the parts of depreciated assets that should be recorded separately with other expenses. So it is good now to do this exercise on your own, so that by using your figures, it will be easy to understand more.
By the year 2030, Rwanda's most successful person will be a young social entrepreneur. That could be you. Join AOG to understand business world and learn entrepreneurial skills. For more information, please call the number or visit the website displayed on your screen.